Today I'm working more on my stock market project. It'll be a bit of a short stream today. I'm only planning on working an hour because it's Easter and I have Easter celebrations to attend to. But I'm working on this every day. The next 2 weeks I'll be traveling for work, so I'm not sure how I'm going to be able to stream. So I might do regular streams the next couple weeks. I might be off for 2 weeks, and I'll be back when I get back for my work trip. So let me go over, before I get started, I'm going to go over what I'm working on, where I'm at, and what I'm going to be doing today. So here's the general model outline plus the goals I have for this project. So first goal, beat the S&P 500 by a significant margin and make money in all regimes. So if the S&P is going up, if the market's going up, I want to be doing way better than the S&P. Similarly, if the market's going down, I still want to be making money, but I'm happy to settle for some small return if we're in a recession, like it looks like we're going into right now. But I don't want to be, if the market's going down, I don't want to be beating the S&P but still losing money. So at the bottom is the outline for the strategy. We have stocks. I have data for all stocks going back to 2011. Oh, I should say my second goal, so I'm writing all of this in Python code, so I'm generalizing all of this, and I want to have some coding framework so that anybody can create models for themselves, not have to worry about getting the data. You don't have to worry about, creating the features, making sure that's working. That's a really intensive process that I've been working on for over 3 months now. So the goal is to synthesize all this work into a tool so anyone can start from the model generation stage. So this is kind of how the outline works. Oh, and I have one important requirement on this tool is everything should be free. So I found a really good free data source. The link to that's in the description if you're interested. So here's the outline for the model. So I have data going back to 2011 from that free data source. You don't want to use all stocks. So you don't want to use stocks that are low volume because those have a big slippage. There's a big spread in the bid-ask spread. And so you're going to have some slippage in your prices, and on the it's going to be harder to sell. And if you scale the model up, you really want high volume stocks so that your model scales with a lot of money. If you have a really successful model, my goal is to have something really successful that then I can get funded by quant firms. The first thing you do is isolate a stock universe. An example of a stock universe would be the S&P 500. If you could just train the model on the S&P 500, that would be good. That's pretty hard data to get, so I'm not doing that. Once I have a stock universe, I'm putting that into the returns model. This is predicting things like either returns for a day, returns for the week, returns for the month, probability of a positive return over any time period, returns relative to the market, things like that. So that's what I'm predicting. And once I have a really good returns model going, I'm going to feed that into a portfolio level model, which is going to take into account the output of the returns model. It's also going to take into account some macro features like Federal Reserve interest rates, the volatility index, the average performance of stocks in the market, and then it's going to decide how to allocate money based on those features. So I started this, like I said, really at the end of last year, so on December 27th, I think it was, December 29th. And I got a really good model going by the end. Oh, I got a model going by the end of January. The problem is this isn't a really great model. I did find some portfolio strategies which worked, but to summarize, these were really fragile portfolio strategies. I needed something more robust. So before I could do that, I needed to clean up the code base. It was poorly organized. So it's now organized in the structure it right. And the good thing about this is it's really flexible and diverse. So if I want to create some new filter to add into my universe, that's just a few lines of code. I could change around the existing filters however I want to clean up the stock universe. I made some feature and target classes. That took most of the time. These are all the features and targets that I've implemented. You can use these features for any time window, and you could also look back any time window that you want. You can shift it by any amount you want. So these are really flexible. I'm then feeding these in. I created a model class, which basically you feed the features and targets into the model. It uses some code I wrote to generate the features. So the features aren't generated before the model, they're generated inside the model. So the model generates features and then does a robust assessment of the model. And I'm assessing it on 5 metrics: information coefficient, so information coefficient is telling you predictive power, and then the next 4 metrics are telling you about the stability of the model. So standard deviation of the information coefficient, information coefficient to information ratio, both on a daily and annual basis, and then the t statistic. So I went through, I found a really good model. I found what I thought was a really good model here, but there were all sorts of problems in how I was assessing this. First of all, well, then I did a walk forward and I saw the performance was falling off with time. But again, there are problems in how I'm assessing the model. So first of all, I was getting features from the universe, and certain stocks are getting dropped out of the universe and added to the universe. So things that have been, say, in January, Apple was in the universe. It dropped out in February and then was re-added in March. My 60-day moving average feature, since it was only calculating on the universe, would have been the 60-day moving average for March and January, since February didn't exist in the data. So I corrected that. I also was adding too many stocks to the universe. So for instance, I was adding the NASDAQ test stickers were in my universe, and those don't change with time. Those are just constant one price, and you can't buy those. So the model was basically biased and overperforming. It was, giving results that were too good for the actual model. I did that. I fixed those problems and incorporated sectors. And since then, I've been looking through different models. I found that basically Model 18 at right here is same as Model 12, but it's incorporating sector normalized features for everything that's mean reversion or a volatility feature. So I'm normalizing those to the sectors, and then I'm normalizing all of the features to the market. And I've been going through and trying to get trying to see how results are. So when I switch the target to be 22 days out in the future, it performs worse, which is kind of odd. I'm not sure if I put the wrong thing down there because, oh yeah, these look similar. But a 5-day target is performing really well. So that's kind of odd. I found earlier when I was using a much worse implementation of the model, I did find that the further I look out into the future, you see here, the better it tends to perform. So I kind of need to make those make sense. Hey, Sir Night Night, and hey, Sing. Crude oil trade's doing really well. Look at, this is the ETF I have. So it's at 137.92. I bought it at 111. Well, I first bought it at $105, and then I increased my position when it was $115. So my average price is $111. So I bought it around March 11th, I think it was. I guess that was my initial buy. Would have been 9th or 10th. And then I doubled down, I think, here on the 16th. And so now it was more like a triple down. And so now half my portfolio is this United States oil fund, and half my portfolio is cash. So I'm waiting for a market crash. Now what I need to do with this is great because I've made a lot of money, but only on paper. I haven't made any actual money because I haven't sold yet. So I need to develop a thesis for when, when's the war going to be over? The whole point of this oil trade was that I couldn't wrap my head around any way the Strait of Hormuz was going to open, because it looks like Iran can basically do what they want. They're taking a lot of damage, but they're withstanding it. And all Iran has to do is basically survive and maintain like a 10% probability, or honestly, even like a 5% of probability of hitting any ship that goes through the strait with a missile or drone. The way I see it, if any ship, if you're the captain of a ship and if there's like a 5% probability you're going to get blown up if you try to pass through the strait, there's no way you're doing it. Now, if that probability is down to 1% or under 1%, maybe they'd start risking it. But as long as Iran has that capability, it's not going to end. Now, it could end if the U.S. decides to totally withdraw from the war, but I don't think the U.S. is going to do that unless they're forced to. So that's kind of where I see things. That's still how I see things. But, you know, Trump keeps talking about we've won, we've won. Trump cares more about the stock market than anything else. So, you know, if the S&P continues to fall, we're going to have issues. And Trump's going to basically do whatever he can to get the S&P to bounce back. But, you know, here we are, February 28th. So here it was at almost $6,900, and it's completely fallen off since then. You know, if this Trump does not want this trend to continue, and we could tell this because look at what happened with the tariff crash. Oh, that's not even included in the 1-year chart anymore. But look at the tariff crash. So then we announced tariffs. This is basically people think we're going to announce tariffs. I forgot when tariffs were announced. I think it was like the beginning of March or end of February. Liberation Day was here and huge drop. So Trump tolerated a 6,000 down to 5,000 drop, but then he changed his tune on April 4th. So 6,000 down to 5,000, what is that? 1,000, 1 divided by 6. So yeah, he tolerated like a 16% drop in the stock market, but then, you know, changed course. And so I think the same thing, look at this current drop we're in. We've dropped from, since the war started, really we could say the high was about 7,000, and we've dropped down to 6,000. So maybe at the worst, now it's recovered back to almost 6,600. So I think maybe Trump would tolerate a drop down to like 5,800, but not much more than that. So that's a pretty big factor. I'm going to need to figure out how to account for that. And another thing to account for is the, you know, crude, a bunch of oil's been destroyed. The oil processing facilities have been destroyed. It's going to take, you know, Qatar, you know, they say for their natural gas facility, it's going to take 2 months for them to get back online. So even if the war ends, there's still going to be this time where things need to get back online, but that's going to be priced into the market. So really, I need to develop a target for when to sell. Back to the stock market model. Yeah, so I'm kind of looking through models now. I've fixed the things I want to fix. I'm still a little bit suspicious about Model 18, but you see the performance here is better. It's going to improve a lot if I incorporate fundamental features, so I need to do that. But that's going to be a big task to undertake because getting free fundamental features, I'm basically going to have to query SEC Edgar, and that's going to be kind of an intensive process, really, to make sure that there's no bias or anything. So I'm going to have to do that. So when I increased Model 12 target up to 22 days, it didn't perform any better. I need to take better documentation because I thought it was performing better. So this with a 22-day target. So what if we change it to just be a 5-day target? And also I need to do the walk forwards again. So let me give this to the AI. So information coefficient 0.01, so barely beating the threshold. Yeah, let's give this to the AI and see what it says about my features, because I need to trim the features, but I'm not sure exactly how. Here is the code I'm using to generate features. To generate my model. Why is this lagging? clean analysis.py and the code for generating features. Okay, so let's give it the results. And let me rerun this model 5. Sorry, model 12 with the 5-day target. Good. Now let's make sure this is on, save, and let's run it. Okay, then let's give it the output and the necessary files and the code for getting the model. Oil's days are numbered in the US, or at least its usage will decline. I think I told you I built a casual investment strategy. It says energy will be the next investment cycle. I basically totally agree with that. The problem, well, so here's the problem with energy stuff is like what sources of energy are there? The the problem with oil is it's a finite resource, and you have to pull it out of the ground, right? Now, I don't see how that problem is any different with like wind or solar, because still you have to pull batteries out of the ground. You could say, okay, we're going to go towards nuclear. Oh, you completed. You mean you completed like a model which is predicting. Um, you mean you completed a model which is implementing a strategy to buy futures? Is that what you mean? Congrats. And that's cool. And how does it work? Like, how successful is it? Not what are the specifics. Um, yeah, so I think it's going to be nuclear too. Um, Basically, nuclear, the one obstacle to nuclear is how people feel about it. 3 Mile Island and Chernobyl. But, you know, that's in the last decade, all you hear is, oh, that's outdated, you know. So the culture is definitely shifting on that. And I think this current crisis could kind of change things. Um, yeah, I think it's going to be nuclear too. Um, and the big benefit and the problem with like wind or solar is then it becomes a battery problem, and then instead of oil as the finite resource, it becomes lithium's the finite resource. So that doesn't really solve anything. And for solar panels, you need copper, or they do it with silver right now. I was looking into this when silver went way up. I had a silver trade. Um, and so part of that analysis was that silver is used in solar panels. So silver is not only like a precious metal like gold, but it's also used in industry way more than gold is. And that you can't mine silver on its own. It's a byproduct from mining other things. Anyway, that's always what I've thought is the problem with solar or wind is then it's, instead of oil, you're pulling lithium out of the ground. It's the same exact problem. All right, so let's give it the files, scripts. Let's do feature engine and clean analysis. And then let me paste my code. And then let me give it the results. Nuclear. So, like you said, Sir Night Knight, I think I need to trim my features, but I'm kind of stuck on how to do that. Um, but you're leaving a massive amount of alpha on the table. You have several mathematical misapplications. You are accidentally double logging variables, passing percentages into functions, expecting raw prices, destroying categorical signals by cross-sectionally z-scoring them. Furthermore, you're missing the secret that made your Model 18 successful. Double log bug, spread AR. Your function explicitly takes the log of the inputs. However, in your feature request, you set input type as log price. Alright, so let's do that. Spread AR, input type as log. So let's change it to raw. TALib percentage bug. NATR is mathematically defined as this because you passed input type as log price. TALib calculates the ATR of the log returns and then divides it by the log price. If a $100 stock moves... Alright, so what's that mean? Calculates the ATR of the log returns, then divides it by the log price. If a $100 stock moves $5, instead of divided by 100, it divides by 4.6. Okay, so this is nonsense. NATR must be raw. You can use a hidden Markov model to carve out the regimes. I wouldn't cut features right now. The regimes determine the features. Regimes change quite a bit from trending to mean reverting. How often your regimes change depends on the time frame you're trading on. Hidden Markov model. Thanks, Sir Night Knight. More great advice. Happy Easter, by the way. Yeah, so okay, I won't trim anything out for now, but I need to fix this stuff. So NATR input type should be raw. NATR thanks, brov. That's what my friend, I have a friend who always says, brov, hey brov. Destruction of categorical signals. Your ADX regime, okay, but it's still the most important. Alright, remove CSZ score from regime and crossover. Yeah, so if it's a noise regime, you probably don't want to buy anything on it, right? Um, even though ADX regime and MA crossover were being neutralized to the market, SMA and EMA on log return. By passing SMA and EMA with input type log return, you're simply creating highly collinear cones of your momentum feature. Drop SMA and EMA on log return or change them to raw if you want to capture cross-sectional price level distances. Alright, let me try commenting out SMA and EMA. SMA. Is that model still running? Yeah. Since different stocks have different prices. The future strategies don't attempt to predict. I've empirically determined that you can't do that reliably. What you can do is read the market and identify causal factors for what will happen next. But then how do you like normalize the causal factors to each other? So like I guess a causal factor would be like interest rates change. It can't be something like the US started attacking Iran, because there's no way to quantify that really, right? Or is there something that I'm missing here? Um, all right, how are the time windows I'm using? I don't want to I'll say I want short, medium, and long term. Okay, so here's the results. Feature important. So even when I'm normalizing the regime and stuff, it's still the most important feature, which is kind of odd. Here's the output of the model. Looks pretty good. Yeah, and every metric is really good. We're good on information coefficient, standard deviation of the information coefficient. The ratios are really good. T-statistic is even good. This looks really great. So let me put it in. Now, 5-day, 20-day, and 60-day beta. I haven't answered that question. So let's say 5-day forward target on model 12 with 160, 20, Now let's make a new slide. Model 12 performance with changes to features. You will find certain features work better for trending and others for mean reversion. It will improve. Yeah, so once I do the Markov model, okay, so let's put the changes in. Okay, so what are the changes I made? Let's look. First point, I'm sure you did it correctly. I have input type raw. Let's address your. All right, enough with that. Excellent questions. This exposes a fascinating quirk about how LGBM works. MA crossover outputs a 1 or 0. If you cross-sectionally z-score this across the market on a day where 60% of the stocks are in an uptrend, the mean is 0.6 and standard deviation is 0.49. The 1s become even higher, the 0s become more extreme as well. Still only unique values. Oh, right, okay. Okay, so I'll add those next. Let me try it with just these changes first. So what did I do? My future strategy is event-based. It's based on individual trades that come into the market. I analyze each trade and read market intent. Oh, good. So that totally normalizes it. But you need, that's your order book edge, right? Read market intent through informed traders who dictate price. Yeah. So what classifies an informed trader? The more money they're risking, the more informed they are, is the assumption, or something like that. Changed spread AR input to be change spread AR input to be raw instead of log price. Oh yeah, well, that's good. The more money they're risking, the more informed they are. So I changed that. Removed transform from ADX regime and MA crossover. Yeah, so you need, for that, you need good order book info. I mean, obviously you know this, but I think it seems like there's a lot of information in there, because if you know who's making the trades, that's a lot different from just the price movement in the market. If a bunch of morons are trading something, stay away. Remove transformation. Removed SMA and EMA because they are collinear with momentum and z-score. All right, so if I just make those changes, oh, don't comment those guys out. Comment these guys out. And then I need to think. Oh, and then run it, and then I can think. So save. And then what was that feature? AR input. AR. Spread AR is now raw. And remove transform from ADX regime and MA crossover. ADX regime. So remove the transform, moving average crossover, remove the transform. All data isn't made equally. Some providers have horrible data that I think, yeah, I'm sure they get paid for that. Oh, but I'm sure there's some way to like calculate how good the data is. All right, so let's go back and run this now with these changes. ADX regime and moving average crossover. I just removed those, right? Yep. ADX regime. Good. Okay, so let's run this again. Okay, then let's think. look at the problem I was having yesterday. I am not able to calculate ADX regime on a 200-day window without dropping a lot of features. So that's my first problem. What are the other suggestions it gave? 5, 20, 60, 200. You're calculating skew and kurtosis on a 5-day window. So let's say model 12 with additional changes. Let's put in here, what changes am I going to make? So removed short term, skew, and kurtosis. So what is the logic there? So add sector relative momentum and sector relative volatility. Agile learning AI model. It should beat the wheels off of models like agile learning. So what? It learns as it goes? And what is NQ? Okay, I'm not able to calculate without dropping a lot of days out. How can I fix this? And where's the model at? How are we doing? Trial 5. So we're doing 50 trials. So We'll see how that improves. And I forget, I should have looked at this before. Oh, so it's not improving much. Maybe more trials would be better. You're absolutely right. Yesterday we discovered... Hey, Wayne. Oh, and... Oh, NASDAQ. Yeah, let's see. What is an agile learning AI model? I like Sir Night Night. He's industrious. Use static weights and a static mixture of experts. They determine the number of experts. The weights on mine are static, but the model dictates how many experts it needs. Oh. Hmm. Trial 22. Okay, I gotta go to the bathroom real quick. I'll be right back. You want this bone, buddy? You're almost done. Buddy's almost done with his bone. Good boy. Yeah, I just looked it up. Some people are calling it dynamic mixture of experts. Okay, so this guy's almost done. Let's see how it performs. Trial 46, trial 47. All right, let's see the output. Good, we increased information coefficient. This guy still looks good. The returns are much higher. What went wrong here? The problem is I want to avoid drawbacks for a long time because, yeah, I don't think I could just eat losses from, oh no, that's about a month, so rough month. Okay, so that's performing better. Let's put that in. Oh, not there. Let's put it here. Where do I put this guy? Hmm. Like always, Sir Night Night. That's good though. Tell us interesting stuff, then delete it. I missed, I don't have any of that information in my head. Um, so let's put in labels. Previous model 12. You okay? Don't throw it up. Keep chewing it. Hey, I'm gonna take that away. Don't swallow it. My dog just swallowed a huge chunk of bone. I guess he's fine now. I think he swallowed it, threw it up, and then swallowed it again. Then let's put a table. With improvements. All right, so green is if it improves. So this guy, what did I have previously? I'll actually document this with the next model run. So now if I remove short-term skew and kurtosis and add sector relative momentum and volatility, does it improve again? All right, what time is it? All right, let's focus so we can do this. So model 12 with skew and short-term skew and kurtosis. Short-term skew and kurtosis removed. Okay, so let's say here, skew, kurtosis. All right, so take out skew and kurtosis here, and then say if window is greater than or equal to 20. Oh, close out the list. So if window is greater than 20, lib features dot append skew lib features plus equals this list, which has skew and kurtosis. Okay. And then let's see how this runs. So I'll either keep it or take that out, depending on if it improves. And then let's say, what was the other change? Model 12 with sector relative momentum. Okay, so I'm going to go through these changes. I'm testing this change. We'll see if it improves things. If it improves things, then good. If not, we'll just revert it. This change definitely improved things. What else? Yeah, look at what an improvement this is. So cumulative spread climbed up to just below 12 here. Now it's climbing up to 16, just below 16. It's definitely an improvement. You see here where it dipped down, and here in maybe that's like October, beginning of October, it's still below where it was maybe around April. But here it's climbed up above that. This looks much better. All right, so let me finish documenting this. So information coefficient was 0.0255. Standard deviation of information coefficient 0.1082. Daily ratio 0.2351, so way better. Oh, way better than the initial. I'm not sure if it's going to be way better here. Annual ICIR 1.669. T statistic 2.7857. Okay, now with the improvements, we're getting better on every metric. So 0.0262, 0.1050. So it's under 4 times now. 0.1050. Oh, let's exit out of this guy. Terminate. That'll make it run a lot faster. 0.10. What was it again? Yeah, 1050 divided by 0.0262. 4. Really? That's 4? Oh. Hey, Panic Compiler. I'm good, thanks. How are you? Happy Easter. I'm good because it's Easter. Things are going well. My model's going well. Everything's good in my neck of the woods. So daily ICIR 0.2491. Better. On an annual basis, 1.7687. T statistic 2.9203. So hitting all the metrics, hitting all the goals, and outperforming the previous model. So good. If I can, you know, I'm getting pretty close here. I might be able to do a price-only model. Because incorporating the fundamentals, I think, will probably take several weeks. It might take a month. And then getting it to the point where I'm confident in it, probably a month. So I'd like to get something paper trading before that. But we'll see. So now if we remove short-term skew and kurtosis, how does it perform? So let's just copy these guys. What do you mean? Like, how am I gonna do it? I don't know what exactly I'm gonna do. I was looking at this several weeks ago, and I forget what it's called, but it's some service which basically is good for algorithmic trading. You can just plug in your model output into it, and it will automate the buys and sells. And they have a paper trading version, I'm pretty sure, but I do not remember what it's called. So, um, I kind of haven't worried too much about that because my model, basically, I had something I thought was good. I guess it was like 3 weeks ago now, and I've been going through trying to improve it, and I found a bunch of bugs in the training, and feature generation, and how I was defining the universe, and I've been going through and fixing those. So then the performance got really bad while I was fixing those, but now I'm back to a good model. So while the performance was bad, I stopped worrying about paper trading, but now I'm gonna have to look back into it. So this guy, trial 17. Let's see if this improves. Now we're gonna say if we add just sector relative momentum and volatility. Volatility. Do I want to add this for all time windows or just certain ones? And I'm kind of concerned because I think there might be something wrong in my sector logic because when I added sectors before, it was improving model performance, but now it's degrading model performance. So once I made all the changes to the feature engine, it started degrading the model performance. So I want to make sure I'm calculating that right. But we'll see if it improves. This will kind of be the telltale sign. If this makes it worse, then I'll know something's wrong and how I'm normalizing to features. Sectors, I mean, not features. If it's still good, then we know we're good. So let's copy these guys. This should be done soon. We're up to trial 30. Let's see what this guy says. Yes, I did. Claude and this guy. Gemini Pro I now have a subscription for. So I'm paying $40 a month to get more requests on these guys. But I like Gemini Pro better, but I'll use Claude when this runs out. Claude's really good too. Here's Claude. But I was resisting paying for it because I don't like paying for stuff. I'm a cheapskate. But it seems to be helping a lot, and it was driving me nuts when I ran out of requests. So I guess they have good business models, right? Maybe that means invest in Anthropic. Good, so let's add those guys in. We can do that at the beginning. So let's make that a new model. Model 21. I was using Claude Code from desktop, which isn't the same as terminal, obviously, but from desktop it was going really slow, and like it kept like it was just happening upon some like very simple errors. Gemini just seems like it's better. It's better at writing code. It's better, like, when I give it the code and say, hey, there's a problem here, help me fix it, Claude will, like, identify, like, 5 like false problems before it happens upon the real problem. And Gemini, like, maybe sometimes it'll do the wrong problem once, but Gemini's way more efficient at finding the problem. It seems like Gemini's better at like higher level thinking. Yeah, I agree, Sir Night Knight. I think Gemini's more intelligent. Um, so model 21 is same as model 12, but has the addition of the following sector relative features. So we have, all right, this guy's almost done. Let's see how it does. Where'd the internet go? Claude code and terminal. Okay, several other people have told me the same thing, so I'm going to add that. Momentum, volatility. All right, let's just put those. Momentum, volatility, ATR. Okay, and do we improve is the big question. So here are the features, you know, kind of the same stuff. Here's the decile analysis. That looks okay. Oh, long short spread is getting higher. So I think these, whoa, information coefficient 0.0295. We're approaching 0.3. That's crazy. I've never gotten close to 0.3 before. So let's see, let's put the previous guy in. Let's see, do we improve on every metric? That would be huge. All right, so information coefficient higher. Information, the standard deviation is lower, good. The daily ratio, 0.28, is higher. Annual ratio is higher. T-statistics higher, so better on every metric. So let me just grab a screenshot of this guy. And we could put the other guy in, but first let's add those features we wanted. So momentum, okay, I'll document this later. Let's just write the code in really quick and we can run the model quicker. Where are we? So if test model 21 is equal to true, pass, just leave it there. And then let's go to test model 12. Okay, and then at the top, we're going to add in this code, but I'm going to take out the momentum thing. Copy. Let's put for window and window. Okay, so we don't need market momentum. Oh, just take out that. Sector momentum. Oh, no market momentum, right? Get rid of that. Up here, let's add test model 21 is equal to 1. And this should, well, we'll see if this gives us an improvement. And this will also be the test for if the sector neutralization, if this makes things worse, then we'll know sector neutralization is no good. Good boy, buddy. Buddy's coming out to beg.
Hey, Pat.
Yeah.
I looked and it's an hour to get there.
Yeah.
Say a half hour to get around. So your plan, I was thinking, so let's say you leave at 7:45, leave your phone here.
To be safe.
7:45, and then an hour is 6:45, another half hour for getting around
6:15.
is 6:15, and then you've got to leave at least an hour and a half for your
So we should leave it like 5.
I would say 5 at the latest. You're ready.
4:30 to 5.
4:30 to 5, yeah.
Oh my gosh. All right. Well, I'm gonna finish my stream soon, and I'll come out.
Do you have a suitcase?
Yeah.
I got it out.
Okay.
Yep. Okay, so model 21, just to make sure it's good, sector momentum, sector volatility. Yeah, so let's do model 21. But I took out relative range, ATR. That's good, good. Good, okay. So now let's make sure test model 21 is turned on. Model 12 should be off. And let's run it. Does this give us an improvement? I've already got that in the PowerPoint, right? Yep. All right, model 21, let's see. So this gave us an improvement. So let's add conclusion. We get an improvement on every metric, so that is terrific. Okay, so let's see. Yeah, we're way up in really good metrics. So once this is done, let's do a walk forward on model 21. I'm hoping model 21 will improve the results even more. But 0.1023, 0.0295, 0.2885, 2.0479, all of those are really crazy values. I'm getting like 10x my goal for the daily ratio. Look how good this looks. It's just a steady march forward with really kind of just significant pullbacks too. Even look, it avoids the it's avoiding the drop from the tariff drop, the tariff crash. There's no tariff crash here. That's amazing. It marches way up during the tariff crash. I guess because you would do well from shorting things during the tariff crash, because this is long short, so. Before implementing the sector neutralized features you gave in the last, intelligence and coding ability are two different things. Yeah, but Gemini seems like it's better than Claude at both, in my opinion. Sector neutralized features you gave in the last prompt. Is this model good enough to begin paper trading? Okay, let's just screenshot. Okay, so that's going to take a while to iterate. So next thing I need to do is walk forward on model 21. Gonna do all of this, features and target, but then just do a walk forward instead of doing the model. Alright, so features and target. Model 21 walk forward. And it's going to use, so advanced models, run walk forward analysis. Target features, folder path, Target type is regression. Train years 4. Validation years 1. So we could keep those. Let's just change end trials to 100 to make sure it's getting good metrics for each model. And then train years 4, val years 1. I'm gonna change train years to 5, val years to 2. Test years should still be 1. Okay, how's this guy? Trial 8. The target is neutralized. Oh, it just doesn't get how the code works. You're now using LightGBM to predict, well, this stock beat the S&P 500 next week. That's fine. Yeah, that is my plan. Okay, I need to do the shadow feature selection. So let's add another slide. Can move that down, no problem. Let's actually just make it a little bit smaller. Have you considered using the anti-gravity? Yes, I was using anti-gravity, but then when I was giving it stuff, it basically was just getting lost. It was taking way too long to think about like the broad, high-level stuff. So I find it works way better if I just give it low-level, pinpointed things. You know, write this function, do this thing. But for any broad-level stuff, it seems like it gets lost. So I guess 50 trials is fine. All right, trial 35. What was the other thing? Okay, so I want this, but let's add a new slide. Does shadow feature removal improve model 21? So this one will be model 21. Model 21 with shadow removal. Shadow feature trimming. So that'll be the next thing. So we could actually try that out here. So clean analysis, what's that called again? Train model, test model, evaluate, apply, shadow feature selection. So model 21, before we train the model. Okay, we're up to trial 40. So I'm just going to run this a second time. So let's go back, make sure we didn't turn on the walk forward. So get that guy out of here. And yeah, turn it off, but keep the code. And then I want to see, does this improve? Yeah, that's fine. So if shadow feature reduction improves it, so where's model.train? Split data, tune params, train model, yeah. Yeah, it's a brutal time to be a software engineer right now, isn't it? You have like extremely useful skills. Brutal for employability. Who's even hiring? Isn't everyone just firing software engineers right now? At least the big companies are. Maybe a startup is the place to be. Here we go. 47. We just need 48, 49, 50, and we'll get the results. I hope it's improved. But we'll see. 48. Trying hard not to find another job. I didn't even see that part. I think because unemployment's pretty good, right? That's funny. It is nicer, you know, if you're on unemployment, you get, you know, you don't have to worry about money. So this improved some things. Here are the features. Here's the decile. Ooh, that looks better, I think. But the returns aren't as high. Yeah, okay, so that's worse. So information coefficient's worse. Standard deviation is better, but the ratio is about the same. The ratio is worse on a daily basis and on an annual basis. T-statistics worse. So this is worse. So I need to look into that, but let's say, so now we could just try model 12 with the feature reduction. Shadow feature selection. Apply shadow feature selection. So change this to model 12, model 12, model 12, and let's go back up to the top here, turn model 12 on, take off model 21, so model 12 on, and let's run it. Okay, now let's say the new model with the sector neutralized features you gave performs significantly worse. Could it be that the sector neutralization is somehow being performed incorrectly? Yeah, that's the problem with jobs, is usually you end up doing something you don't really give a shit about. Okay, so I'm gonna see, does the shadow feature reduction improve the model? If it doesn't, I'm just gonna do walk forward on the model. But that's it for this stream. It's Easter, so I've got to go celebrate Easter. So thanks for watching, everybody. Subscribe and like the stream if you haven't. That helps me out, please. And have a good rest of your day. Happy Easter. Adios.